welcome back. Now, Nigeria's credit to the private sector recorded a decline of approximately 9.65 trillion naira. That's from February to March this year, and this is directly linked to that hawkish stance of the Central Bank of Nigeria. That's 700 basis points hike on the MPR so far. The credit and monetary statistics data from the CBN indicates a 12% month-on-month decrease in credit allocation to the private sector. And this figure shows that it went from 80.86 trillion naira in February to 71.21 in March. What does this mean? What exactly, or who is feeling the pinch of this? Let's speak to the co-founder of Vendor Credit. Mr. Oluseyi Shetan, joins us virtually from Lagos. Mr. Shetan, thank you for your time. Good morning.
Thank you for having me, Elaine. Pleasure speaking to you.
Great. So tell us exactly how or where this is pinching. I mean, the last guest, I wonder if you listened, I was talking about the CBN. Obviously, we've seen they've been aggressive about dealing with inflation through the hike of MPR. You deal with the credit and the small businesses. How and where exactly has this been pinching so far?
Well, it pinches everywhere. The last speaker spoke extensively about, what has led us to where it is that we are. And he has also emphasized on the fact that, these challenges are deeply felt by businesses. If it was easy doing business before, now it's tough. Corporate borrowings from the banks, as you have reeled out, has reduced significantly from the 80 trillion that it was in February of this year down to about 74 trillion. Even corporate bond issuances have dropped significantly as well. I think as at the last figures that we had, they did of just about $1 billion in the whole of H1 of 2024. And we've seen that decrease occurring over commercial paper issuances as well, down to about 503 billion for the whole of H1 of 2024, compared to over 800 trillion for the 800 billion for the same period of 2023. So you can imagine the impact of that on all the costs that corporates are having to deal with. On the supply side, we've seen a jump up in transportation costs, obviously, off the back of the removal of the fuel subsidy. We've seen production costs go up as well because of the import dependence of some of the raw materials that we use to manufacture in the space as well. On the demand side, we've also seen challenges because purchasing power hasn't increased for the consumers. And off the back of that, what they're able to purchase from you, has decreased. So you might see revenues go up, obviously because of adjustments in price. But when you're talking about quantity consumed, you see a decline in that. And you see companies having to start looking at innovative ways, to be able to manage their costs, because that cost they're incurring has to go somewhere. The consumers can't take that cost fully. So the costing company has to incur some of that cost and then pass it on with the vendors in which they do business with, and also find innovative ways in which they can somewhat reduce their cost of production without necessarily impacting on the quality of the products in which they're pushing out. So these are really, really tough times for companies in the private sector in Nigeria. Mm-hmm.
So it does sound like, even as I think you hinted, is businesses have found innovative ways to survive, because even the PMI for July did show that purchasing cost is increasing, but purchasing is still also increasing. So perhaps there are some strategies or innovations that have been adopted that is helping businesses to survive.
Yeah, so a lot of guys are starting to look for alternatives. If you have imported items, you need to start looking for local substitutes in which you can use to replace that. People are having to look at, complementary products in which they can use to sell the items that they are selling in a bid to just drive overall sales volumes. There's a lot of credit that is going out to distributors, which are the guys that are buying the items, such that at the end of the day, the products are able to get into the hands of the people that need it. So it's a lot of innovation. Partnerships have become very critical as well. Traditional guys that typically wouldn't look at fintechs, for instance, to do business with them, that door has been opened because they are more nimble and they are slimmer and able to also be at the forefront of innovation. So we see those collaborations occurring just to ensure that at the end of the day, businesses are able to weather the storm that exists. And we've seen the impact of not choosing to go that route as well. We've seen over this year alone, we've seen multinationals exit the country. We've seen Kimberly-Clark, just to mention a few, GSK, even Microsoft, right? The tech innovation giants have had to pull out of the country as well. But I mean, what that does ultimately for everyone is that it also creates opportunities for local participators, players and entrepreneurs to come into those spaces and try and fill the voids that have been created by the exit of those multinationals. So those are some of the things in which we're seeing happening in the space that are, trying to address the challenges, enable businesses to overcome or find reasonable ways in which they can work around the challenges that the harsh economic environment in Nigeria currently presents.
But what's this doing to the supply chain landscape in Nigeria? Which way is it going? How is it changing?
Oh, it's tough. If it was tough before, it's much more tougher right now. I mean, energy is a major driver of cost, right? When you're trying to do logistics, and supply chains are also heavily dependent on logistics, whether you're bringing the items into your warehouse for production or you're taking it out to the distributors for final distribution to the consumers. So we've seen, those costs go up as well. I mean, FX, for instance, has its own impact as well, because all the spare parts that your logistics guys use, they have to import those items. And with FX, almost doubling from what it was even at the parallel market to the official rate, it just makes it a lot more difficult. We've also seen a lot of companies. In the past, companies had maybe payment terms between their vendors of, say, 30 days, but they've had to go innovative and say, you have to increase this tenor. So instead of 30 days, we're seeing tenors being increased to 60 to 90 days. And, margins are still trying to be held as tight as possible just to ensure that, the companies can survive. So it's really, and we can see the final impact as well in the final price of the goods that are being consumed. We've seen all beverages, even flour and all the items that people consume, right, reflect the increased cost in supply chain. So that's where the situation currently is regarding that.
Do we have more incidents of bad debts, missed timelines for debt servicing? Do you have a record of something like that?
Could you come again on that, please?
I mean, all of this, has it resulted in maybe more bad debts or timelines being missed when it comes to debt servicing as the MPR increases?
Oh, yeah, definitely. I mean, when you increase interest rates, it's a confirmed and proven fact that when you increase interest rates, typically your defaults increase as well, asset quality reduces. And that's because, that cost has to find somewhere in which it could be borne. And, by virtue of what's going on in the economy, where there's a general, when there's a general inflation situation and, general economic hardship, people have to sell for them to be able to generate cash flows to be able to repay on their obligations. So defaults are obviously going to go up. In line with what we've seen happen on the pricing on the interest rates. So defaults are definitely going to go up. So everybody now needs to start thinking around sectors in which, identifying sectors where opportunities lie, right, that are somewhat resilient to the overall impact of what's going on in the economy, or not as impacted as many others would be. And that's where you want to concentrate your credit as it is right now. And in terms of timing, like you rightly said,
would that be the fintechs? Would that be the fintechs?
Pardon?
Would that be the fintechs? They're supposed to bring solution at times like this.
Oh yes, the fintechs are currently at the forefront of innovation because obviously we are trying to penetrate into the market. So a lot of the traditional ways in which lending used to occur have to be reviewed. You need to look at creating new parameters, right? In addition to some of the ones that you already have, to source on data from the clients that you want to lend to. And then off the back of that, involve artificial intelligence as well as proprietary algorithms that exist that are developed in-house to be able to, determine what the new credit analysis structure should look like and what the new credit scores for customers should look like. Fintechs are still, at front of that.
All right. All right, thank you so much. A lot of work for the fintechs, an opportunity also for them to shine. There's always an opportunity. Making lemonade out of lime. Thank you so much, Mr. Oluseyi Shaitan, co-founder of Vendor Credits, for your time and your thoughts.
Thank you very much, Jenny.
All right, so just a little bit of the markets now before we head back. Yesterday was another red day, dropping further for the all-share index. 96,000 now is what we have, 96,928.52 after it lost 0.67%. Equities cap also dropped. That's 371 billion naira shaved off the market right there, even though there was a positive for banking, consumer goods. But I think that it was the industrial goods that really brought down the market yesterday because it was down 3.69%. We'll give you details and intraday numbers at 1 p.m. Ladi Williams will be here with Anyeti Ede. Let's head back to the Sunrise Daily Studios.